Jack gets married to Jackie.
Mm-hmm. Right.
And they hire a DJ.
Yeah.
I wish I was lying about this.
Yeah.
The guy's name is DJ Jackie Jack.
Yeah. Coincidence. It's weird enough that it's Jack and Jackie, but then it's Jackie Jack.
Well,
the DJ.
Was it a coincidence? I mean, like, at what point did in the introduction of him being like, "Hey, my name's DJ Jackie Jack"?
Are you insinuating that we went through a list of DJs?
Yes.
And we said this is the guy?
I'm not insinuating. That's exactly what I'm saying.
All right. Well, we'll take this up later, but it didn't happen. I swear, it was just meant to be. He rocked. We had a band at first, which I thought was great.
Band was great,
and then it transitioned to a DJ, who the guy was huge. That guy was like 6'6".
Yeah.
I don't know if that
helps him. No, I don't.
Yeah.
I genuinely don't. Also, he could have helped us lift the chairs then if he's so big, strong. Yeah.
Yeah. Why didn't you help out there?
I don't know.
Yeah. Well, I guess you should also, tell us about, you were just at the Jersey Shore over the weekend. And I think there's this connotation that when you go to the Jersey Shore, it's like the show Jersey Shore.
Yeah.
Can you explain how it's not that everywhere?
It's not that. That's literally centralized to Seaside Heights.
Yeah.
And like that, 5-minute area on both sides of it.
Right.
No, Jersey Shore is actually a nice place.
Okay.
As somebody who grew up in Monmouth County, the shore is like beautiful. The beaches are pristine.
Yeah.
They're paid. So
were you on the beach at all? Did you get some sun?
We didn't. All right. You know what? Stop recording. I'm out.
You could have gotten some sun at least.
This is the most tan I've been in 365 days.
Okay. You ever watched the movie or the show?
No. Stop.
Okay,
Stop. You owe me some respect for my tan. This is insane.
You look great.
If I pull up episode 1, I'm translucent.
Really?
I'm pretty sure.
Do you think anyone out there compares episode 1 to say episode 10 on like how we evolve?
You don't do that? I'm the only one.
Well, that's cool. All right.
Hey, dude. Welcome back.
Yeah. Thank you. We made it to whatever episode this is.
Yeah.
We've gained a few followers.
Yeah.
But, we're getting there.
Is this going to be the running joke?
I'll stop it.
Yeah. I like it. This is your dad humor. You've got 2 jokes that you like to run. You like the 15 followers, which by the way,
it was funny at first. It was funny.
I love.
Thanks.
Highly support.
Thanks.
But now that we're up to like 25, it's time to cut it because now we're a big
We're getting
deal.
somewhere.
Second one that you absolutely love is, do you know what it is?
If you have good comments, talk to me.
That's it.
Yeah, I know. Listen, so the thing is,
that's classic.
The
dad
truth
humor.
is, I'm a dork. Like that's
no
it.
way.
That's just it. Okay.
No way.
And dad jokes are definitely a thing that I do, and I'll embrace it. I'll embrace it. By the way, the other day, when you asked Josh, let's hit the hard hitting questions up first. What's your credit score and who are you voting for?
Yeah.
I still laugh at that.
I didn't anticipate that he would answer that. Josh, you're the man.
Yeah, you're amazing.
I can't believe
that was fun.
How good spirited you were. Yeah, that was great. It gave us a thorough explanation.
All right, let's get into it, should we?
So what's in the news this week?
We're gonna hit the daily roundup here. Basically, I think we're taking some of the top clicked on stories.
Yep.
And kind of summarizing them. So I think the first thing is just multifamily troubles, right?
Yep.
Which we've been talking about every single day for the last 2 years.
Yeah, it's definitely the ongoing theme. I don't think anyone's not aware of it at this point. Cred IQ kind of had that gangbuster headline with CMBS loans skyrocketing 185%, right? Something like that over the last 6 months in terms of delinquencies. And it's not just CLOs, right? It's CMBS.
Right. And that's what's interesting because in the news, we've heard so much about these collateralized loan obligations, these CLOs that a lot of these, kind of syndicators have been using for these, value add deals, short-term bridge debt, floating rate loans that have gotten into a lot of trouble. But it's not just CLOs, it's also CMBS debt because that's usually longer-term fixed rate loans, more stabilized deals. But a lot of those loans are now starting to come due.
Yeah.
So what's going to happen when they come due in an environment where interest rates are so much higher?
Yeah. So I think it's interesting that, when we're out in the debt markets, one thing we've seen, the volume of debt available for office is like practically zero, right? It's not zero, but it's damn near close to zero. I don't know how many other asset classes are experiencing that. Like I think we saw that the retail loan markets are kind of frozen, which is really interesting. We'll get into the retail thing in a second, but for multifamily, a lot of maturities coming up, right? Over a third of all the loans due are over the next 18 months. Like that wave is about to hit.
Right.
It's we're talking a year and a half span.
35% of all multifamily loans are maturing in the next 18 months.
Right. So let's think about the maturity in terms of like what actually matters, right? We already know that a lot of these delinquencies or this default rate that we're seeing, it's maturity default, right? So it's not like they're not paying the loans, which makes it interesting, right? So if you have investors who are waiting, to get repaid, becomes a little bit tougher, right? How many of these actually get forced into foreclosure? Or, lenders actually pursue that? TBD, right? That's definitely the big question mark. But it seems like a vast majority of this market is willing to accept longer duration. They'll take the payments. They'll have some kind of workout. Maybe there's even a kicker at the end.
Yep.
But if not, and let's say you're the bank holding this note, you didn't lose your money.
Right.
You got more interest out of it. The bond, definitely didn't yield what it was supposed to yield in the beginning, because of the drawn out durations. But it's not the end of the world. Right. And I think that's part of the trouble in the news that we're seeing.
Right. And the news likes hyping up all the negativity because it sells, right? I mean, we're more prone to read the negative headlines than the positive headlines. On that note, let's talk about Tides, right? I mean, this goes right into that. So, Tides is one of the more well-known syndicators really in the country. What they did was phenomenal and very impressive. They kind of mostly started in Arizona, started syndicating a ton of multifamily deals there, and then they eventually transitioned into Dallas, where they saw the growth happening there. And, for a while, they're crushing it. But they use a lot of these, CLO sort of backed loans, and they have either been coming due or the interest rate on them has just floated up to a point to where they just can't sustain it anymore. And so I guess we saw one more deal get foreclosed on in Las Vegas. That's right. And, they recently just lost a couple more deals in DFW. So it's unfortunate, really sucks. I mean, no one wants to see anyone losing anything, and no one wants to see investors, losing their equity. But I think it's going to happen a little bit right now. Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns.
So if you go back to what we were talking about in terms of what happens with some of these maturity defaults, right? Where it starts to get precarious is how much equity, we know that there's $400 billion of dry powder sitting on the sidelines.
Right.
That everybody talks about that. I've been hearing that for
forever,
3 years.
Right? Same.
Yeah, at least.
Yeah.
But how much of that is going to be available to take out, what is already deemed overvalued multifamily complexes, right?
Right.
If it's fine that we can, as some of these banks kick the can down the road, they continue to collect interest. These loans haven't defaulted. Maybe the property starts to operate better. Who knows, right? Who is the takeout, right? Like, who's happy to put in that much more common equity to rebalance these loans? And I think the answer is not a lot, right? Because this $400 billion of dry powder is seeking distress. They want to buy for pennies
deals
on the dollar.
Yeah.
I could easily see, very plausible scenario where these guys are waiting it out. They wait the next 18 months. The 35% of loans due becomes 60% or 70%. Investors in the banks holding these notes get really pissed off. They say, we need our money now. And either the banks take losses and people pick up the scraps, or I don't know. I mean, that's like, how else does it go down?
This is the opportunity, right? I mean, this is what everybody's waiting for, is, these distressed deals and someone getting them on, pennies on the dollar, which is starting to happen a little bit. I mean, we are starting to see it, particularly in the DFW market, where I'm active. We're starting to see it throughout the state of Texas, and I'm hearing it throughout the country now. So it's little by little, it's getting there.
Yeah, I'd love to hear from anybody who tunes in. Send us a message. I'd really want to see what other markets are you starting to see creep up, because
send us information. I mean, we embrace it. So any sort of feedback you guys have, let us know.
Yep. What else is happening? I know that there's some student housing news, right? Student housing was kind of like the favorite child coming out of the pandemic, which was really interesting. I think it was the first asset class that I saw really bounce back.
It's really interesting because student housing never really was taken that serious for years.
Right.
And really only recently has it kind of come into itself. And so now you have entire ecosystems around student housing. I mean, these student housing conferences have been popping up. It's become a very serious asset class. And, part of it has to do with the fact that it's pretty stable, right? Because you have students moving in and their leases are backed by, guess who? Mommy and daddy. So it's pretty safe. Most of them are year leases. It's rented by the bed. And some of these student housing operators have crushed it and done a really good job, and they've been very safe. I think the risk in student housing has been, in my opinion, more in the kind of secondary schools, right?
Sure.
Because, I don't know, we could debate this all day, the value of an education. I went to, law school and undergrad. If I could go back, probably wouldn't have done any of it and just gone straight into real estate. But I'm sure a lot of people will disagree with me. But I don't know if education is what it maybe once was, and therefore I don't know if these sort of second, third tier universities are going to be as competitive as maybe they once were. But so far, so good with all of them. And I'll tell you, it looks like student housing lease up is a little bit slower right now. But
not that much.
Not that much.
I'm surprised to see that the headlines are saying, the market's softening. Like anytime I see stats, like June pre-leasing is down from 85% to 84%.
Yeah.
Okay. Yeah.
Why is that a headline?
It's
honestly,
softened.
You're right. I don't know.
It's softened, but like,
cool.
Yeah. I don't know.
Let's move on.
Who really knows? Yeah. Who really knows about that? But I do think the point that you brought up is, it's something to think about, right? Like, I don't think it happens next year or the year after, but there's definitely a reevaluation of a college degree.
Yep.
And we see this a lot in the MBA markets.
Right.
Like, people aren't so fast to get their MBAs now. Graduate schools are definitely struggling.
Yeah. Do you think it's less of a requirement?
Programs.
I mean, for a while, if you wanted to get an in at any of these big firms, you needed to have an MBA.
Yeah, well, that's just it. I don't know. I think it's still required, but given all the drama that's been happening with universities, and then COVID kind of slowed down admissions, and people didn't really want to be there because you couldn't travel and you couldn't get a lot of the benefit of the MBAs.
Right.
There's definitely a rethinking.
Yeah.
There's definitely a rethinking, and I don't think it's necessarily like the definitive answer. But it's still really rooted, especially in finance, right? If you want to go work in investment banking or a private equity fund, you see a ton of people with graduate degrees. So,
well, look, it might change when if TikTok gets closed down, all these influencers are going to have to go back to school. So
that's
could change
a good
things.
point. That could change things, but until then,
we'll see.
Yeah, I'm curious. I wonder if this continues to kind of fall, over the next several years, like. A lot of professions are definitely becoming more technical. You're getting a lot of people in like the software space.
And a lot of professions are becoming more commoditized also.
Of course.
I totally
Plus
agree.
the AI factor, how much of it is going to become, general knowledge and being well versed in life
versus how well you can use AI.
Versus how well you know your AI tools.
Yeah, we're going to be having courses, if not already, on how to use AI. It's very weird times we live in. Okay, so let's talk about retail vacancy.
Yep.
I guess retail vacancy is at a 20-year low of 5.3%. Yeah. Not really a surprise, right? Because coming out of COVID, I mean, obviously COVID really tore into that, and then we got really hot, and I think consumers are back out there spending, and now there's not as much, supply coming online like maybe there once was, and so supply demand, right?
Yeah, I think retail's also done a really good job repositioning, right? So you and I both have seen the cycle of real estate, especially over the last 10 to 15 years, where it was a super hot commodity and then completely dipped off. And then you had everybody running towards grocery anchored retail. And all of a sudden there was this huge back. I think the retail investors, retail asset class investors rather, did a really good job knowing what the demand was. Way better than, the office investors seem to be doing.
Right.
Retail kind of figured out their path, and, they now cater to exactly our needs, right? There's virtually no big box stores. Grocery anchored is kind of everywhere.
Yep.
Right?
Yep.
Like
everywhere. It's the
very
thing.
few neighborhood strip centers. And
everyone, obviously I'm focused on the multifamily space, but anytime I'm talking to anyone in retail, strip centers, that's like, we're looking for grocery anchored retail. And it's kind of like, I'm kind of tired of hearing about it because like, duh, that's what everyone's looking for.
And although people aren't, gunning for that high street retail where you used to have these massive valuations, I think that's also like, I say this a lot, but it's very microcosm.
Yeah.
Like you look at Madison Avenue between, I don't know, 61st and 70th or 60th and 70th.
Right.
Huge trades, right? Like
crazy.
Dyson bought 2 retail condos for north of $100 million. So it's definitely strong. Yeah. Which is weird why, the loan markets are still really hesitant to lend against it.
Yep.
Still really fast to give to multifamily,
right?
With valuations bubbling and maturities causing defaults. But like,
it's interesting. Retail. And of course, retail's still undergoing a lot of transitioning. I mean, you have a lot of more experiential pop-ups coming. Netflix announced that it's got a new movie theater attraction in, I think, Philadelphia and Dallas, which will be really interesting, which I'll have to go to. That's very cool. So anyways, that's it. Retail's cool. Coming back.
Jack, I know you're jealous of this. This is something we heard, but Brookfield found a successor.
Let me tell you. I mean, this guy, what a badass.
Yeah.
You know how old he is?
36.
Yeah.
Makes you question, what are you doing wrong? What are you...
Yeah.
How have we gotten here?
I don't get it. Yeah, Bruce Flatt, CEO of Brookfield, announced his successor. It's Connor Teskey, who hope we can have him on the pod. Maybe he's a
us
cool
in
guy.
Our 30s running a podcast for 20 people
versus
Bruce taking over Brookfield.
Dude, it's crazy. Yeah, Connor Teskey. He is the likely successor to Bruce, and for those that don't know, Brookfield about $900 billion in assets under management. I mean, we're talking.
Yeah, those who don't know.
I don't know. Yeah. Anyways, look, I mean, Bloomberg says that this guy is going to be on track to be a billionaire. Pretty cool to be 36 years old, knowing if you don't screw up, you're going to be a billionaire. It's pretty awesome. But I love stories
like that. No pressure, Connor. No pressure.
No pressure, man. And then come on the pod. Maybe he's listening.
Yeah. All right. Well, let's get into the real meat and potatoes of this.
Yes, please.
As us real estate folks like to say. We saw a point that you and I were talking about earlier this week that, I don't know, who knows, now with President Joe stepping down,
crazy
might be completely moved. Yeah, what a wild
crazy times, right? I mean, look, we haven't even talked about the attempted assassination.
The last 2 weeks have been insane.
No, it's crazy. It's what world are we in?
This is like I never thought that we would see this in 2024.
Yeah, and now you got all the conspiracy theorists coming out. I got everyone telling me they think it's a divine intervention. I mean, wherever you're coming from, it's truly remarkable that this is happening in real time, and you can tell we're kind of making history as we go. But yeah, we got President Biden kind of trying to make some last minute pushes in certain policies, and a lot of them have to do with housing. So, rents nationwide have risen, about 30% over the last 4 years. And it's pretty crazy. I mean, I think that it's not sustaining to an extent, although that growth is starting to slow.
So talk about what he is actually looking to do. So he wants to propose a rent cap.
Right. 5%. So he wants to propose a rent cap of 5%.
Yep.
Landlords can't raise their rent 5%. Year over year.
And by the way, that's a pretty healthy raise, right?
Yeah. I mean, it's just compare that to we were seeing, 20%, in some markets. I mean, it was kind of insane. So it's not the end of the world. But
by the way, if I was a multifamily owner,
yeah,
I'd be pretty happy with my rents growing 5% every single year. Not in inflation years where we had inflation of 7, 8, 9%.
But I think some of the concern is, where does it stop? Because once you start down that road, it tends to keep going. And I think that's the concern in the industry. And so just so everyone knows, the way he was going to enforce this is by kind of dangling depreciation out there. So, in multifamily, you have a 27.5-year depreciation schedule. And a lot of buyers buy real estate, particularly multifamily, because of that depreciation. So they can write that off on their losses.
Yep.
So taking that benefit out of the equation will presumably really hurt investing in real estate and in turn hurt tenants' quality of life, right? You want to see new investors coming to the market and improving properties and seeing that happen. So it's not great if it was to impact that.
It's a bit of like dangling the carrot, right? Because those two things aren't necessarily commensurate. Able to, as an investor, being able to claim that depreciation on your taxes and, incurring that loss, so to say, not the same as you could get 5%, but maybe the market doesn't allow that, right? Your market rents might not command that at all. We see that happening in Texas right now.
Yep.
I mean, I think largely we see that happening in New York as well. And New York's been in this real estate cap drama for ages.
Well, I mean, I think the other interesting thing is he's targeting what they're calling corporate landlords. And corporate landlords to them means landlords or owners who own over 50 units. And you and I both know that there's a lot of, we'll call them mom and pop owners who own over 50 units. And it's still a small family business. So, owning 50 units in, I'll say in, Manhattan is probably a little bit different than owning 50 units in, Prosper, Texas. But that being said, still mostly private capital folks. These aren't big companies always. So that's something else to kind of think about.
And it still has to go through Congress, and you've got a Republican-controlled House. Pretty real estate friendly on that side, right? Like we've seen, and by the way, he didn't reinvent the wheel here. This isn't the first proposed cap of its kind.
Right.
We see this quite frequently. It's never been regarded as a good solution. And by the way, if you have a market like in Nashville or Miami that's exploding and driving up prices, I see the argument. You're preserving lower cost housing for the people who live there, but you're far undershooting the demand.
Right.
I
totally get it. And, I think this is kind of a strategic, move to potentially maybe get some votes out there, right? I don't know how realistic he even thinks it might be to get this passed. And there are already protections on the table that are, routinely kind of coming out there. I mean, recently, FHFA kind of announced that they were going to have new tenant protections where, tenants would be required to have a 30-day notice on lease term expirations, 5-day grace periods for missing payments. And the truth is a lot of those protections are protections that, candidly, the good operators and management companies are already doing that. So I don't know if it changes a ton. I'm sure there's some slumlords out there that maybe that helps protect against.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing, offering a powerful way to grow your wealth passively. Passive investing with Viking Capital allows you to benefit from a lucrative world of real estate without the hassles of day-to-day management. Their team of seasoned real estate experts takes care of everything from sourcing high-potential properties to managing them efficiently, so you can enjoy the returns without the stress. I think the point that I was getting to before is like when you're not able to raise your rents to the level of demand that's there, right? What continues to be your incentive to reinvest in the building, keep it competitive, right? I'd almost be happy with, owning this slummed building and collecting 5% rent every single year, right? Do you think, what are your thoughts on that? I mean, you deal with a ton of, private equity guys, especially in the value add space. Like, how do you think something like the 5% rent cap affects them versus?
Yeah, it's a lot of it's psychological, right? You don't want to invest in something where you think more regulations could be coming. The 5% cap on its own, sure, whatever, right? There might be plenty of years where you're not going to hit that, but it just kind of cools the market, and it also makes developers a little bit more weary of developing if they see policies like this coming into place, because again, from their perspective, they don't know if it's going to be taken even farther. And so it's just, the more regulation you put on the industry, the more it kind of hampers, stimulation and development and growth. So, I think that's really difficult to kind of, think about. And by the way, let's talk about New York, right? New York, I think, I didn't even know this, like about half of the units here are rent stabilized.
Yeah.
That's crazy, crazy. And then, the average rent here is like $5,000 a unit, something like that. I mean, $4,500 a unit. So has that worked? Right? I don't think the government,
well, it's even more complicated in New York, right? You have caps around being able to pass through increases for renovations.
Yeah.
I mean, New York has been, back when I was looking at multifamily, New York is by far the toughest market to comprehend and be able to do legally. Like, by the way, you have a lot of owners, like you were saying, mom and pops, who never really kept good records of their increases, right? Didn't file with the city.
So suddenly they have more just transactional costs in operating because they have to keep up with all this paperwork. It just seems like such a pain. And by the way, this is why, I come up here to do business a lot, right? I mean, there's so much capital up here looking to invest in markets like Texas or Florida or just more business-friendly environments where they don't have to worry about all that.
Yeah. I mean, Josh was here the other week talking about that. It's called a spade. It's the red markets, right?
Yeah.
That's who's in favor of the growth.
Yep.
Again, historically, it's not Knox, and maybe we'll see that change over time. But
maybe.
It's always a tough debate.
Yeah.
Some other hard news in the market.
Let's go there.
Not to sound too depressing.
Okay.
Right?
But again, people love hearing the negative stuff. We'll end this on a high note somehow.
Yeah.
We'll find a way.
All right. Let's aim for that.
Yeah.
No, but it's a similar story to what we started out with, right? It's the trouble in the bond markets. This time the antagonist is a little bit different. It's SASB loans, right? Single assets, single borrowers. That's kind of causing the uproar. But it's just another facet to pay attention to, right? So
the default rate for these SASB loans.
Keep talking about defaults.
It's come up to like 8.7%.
Right. Which, by the way, it's not scary, right? When you're hearing that, right? Okay, there's a 8% default rate amongst SASB loans, however big the market is.
You want to explain real quick what SASB loans are? I mean, these are single asset, single borrower.
Yeah. So think of it as very large loans, right? With one borrower. These are typically reserved for like
big
think of
office
a monster
buildings.
asset.
Yeah.
Exactly. So
like,
perfect.
So for most, I mean, CMBS, for most CMBS, deals, you're talking about
Diversification.
Exactly, right?
That's
you have
the difference.
Tons of deals.
Correct.
Within the tranches, and they're being pulled together. So if one goes bad, you're probably
not
still
losing
okay.
the cash flow, right? So we like to use a lot of acronyms. It's what's a bond?
Yeah.
It's a piece of paper, right, that says you have claim to this asset and it owes you a cash flow.
Right.
It's in the simplest terms. Wall Street analysts, feel free to come and scout me for dumbing your
That's
your
what
job
it is.
down
Let's
to
not
that,
make
right?
this rocket science. Yeah.
Right. And to the point that we were making before about diversification, what makes those safe deals? You've got a ton of other cash flows to rely on.
Yep.
Right. And hopefully, you have enough contingency that you can make interest payments and so on.
They're all spitting out coupons, and to combine, the bondholder are getting paid back for that bond, and it's supposed to be incredibly safe, usually, and these SASBs have traditionally been held to be incredibly safe as well, because normally the owner also still has a stake in the building themselves. So the idea is, okay, they're on the hook also.
Yeah, well, I mean, they're safe because the underwriting was tight. Mm-hmm. It's a monster of an asset. It's producing a ton of cash, right? You're talking about a loan that has a borderline same valuations as some of these other large CMBS pools. The difference, though, not just diversification of the asset. Think about your tenant base. Mm-hmm. What if, if you're a SASB loan that got originated for, let's say, Amazon's new headquarters near Bryant Park, mm-hmm. and they have, assuming that they didn't own their building, or even if they did, they're giving a 15-year lease to back that note. Okay, that's safe. It's AAA tenant, the most investment grade.
Right.
But, there's buildings, let's say like 1740 Broadway, which Blackstone owned, which went under.
It had Victoria's Secret as its main tenant, right? I mean, that was 77% of the building.
Yeah, but again, it's not a knock on the tenant, but that's just it. It's 77% of the building.
You're relying on one tenant.
Right.
And we all know what happened, with them. So, that went away, and suddenly, Blackstone had to take a huge hit.
Yeah, this is kind of the problem with these loans, right? You can get smart. You can create traps on the cash. You could have tons of reserves, but what happens if some of these buildings are, occupied by two super large tenants? Valuation. The other thing to talk about is, like, when you underwrite CMBS loans, when you underwrite, SASB loans, any kind of loan, you're not projecting for the value of your asset to go down. That's never in anyone's underwriting.
Right. You're at least going to cover your basis. That's what everyone thinks.
So you have a couple of issues. You have the value of your asset dropping, 30 to 40%, mm-hmm. which has kind of been the average in New York. You have tenants who don't want to renew, who have to break leases early. I've never seen one tenant's lease break clause, cover the entirety of what their lease would owe.
Right.
That doesn't exist, at least to my knowledge, maybe in some rare instances. But this is becoming the problem. Like, even if you have buildings with investment grade tenants where 50%, is occupied by an Amazon or even a Victoria's Secret, right? Mm-hmm. You have a monster corporation. If nobody wants to backfill the rest of the building and you're reliant on that to make these coupons, these become super dangerous loans, mm-hmm. right? Because now you're screwed on value, mm-hmm. you're screwed on payment. This isn't a maturity default situation.
Right.
But again, that's always something to consider. And we're talking about, like, people really need to just understand that this is just another facet of this troubled bond market and CMBS debt that people need to think about.
Yeah.
It doesn't seem like a big impact, this 9% default rate, but when you're at 4% historically, and it's happening in a time of trouble, okay, like start waking up, start paying attention to these things.
We're now about 8% of SASB bonds rated AAA have been downgraded. And you see people, you see groups now trying to take advantage of this, right? So you have TCW Group, which just kind of, is taking advantage of this and buying higher rated bonds with, really resilient properties, expecting a price rebound. And I think, where there's blood in the streets, there will be rewards for those who take on some of that risk.
Yeah. It's definitely something to pay attention to. I mean, again, it's not news like this is the first time we're seeing bond defaults and we didn't know, but some investors who can pick up these, let's put it like this, the loan becomes inherently more distressed than when you have, a building with at least staggered rolls. That's the other thing, right? When you have office and let's say you only have a 50% occupied building,
right?
Sure, but you can make the payments. Most of the time your rolls are staggered. Whether it's large blocks or not, it doesn't matter. It generally doesn't happen where all at once your payments stop. And a SASB loan, it very well could, right?
Yeah.
And again, the underwriters are looking at that. They understand when the expirations are. But when the principal value drops, right, the markets have now kind of underwritten at a loss. And all of your payments stop because your tenant pulls out or breaks early or whatever the case may be. You're you're smacked from both sides.
It's interesting to me that these deals got done. I mean, to me, there just seems like all your eggs are in one basket, so to say. And if I'm investing in bonds, like I want real security, and that's why these conduits with diversification and tons of different properties just seems like the safer bet always. But anyways, okay, let's move on to I guess RealPage is forecasting improved rent growth in 2025. I don't think this is a big surprise, right? We've seen so much supply coming online over the last couple of years and next year as well, but it's starting to drop off. And the U.S. economy added over 532,000 jobs in Q2. So, things are good, generally speaking. I mean, employment gains are really anticipated to be a ton in New York, LA, Houston, Phoenix, and Dallas for the rest of the year. So strong markets still. Also, a lot of those markets have tons of supply coming online.
Yeah. What do you think continues to be the hot markets coming up this year?
I think the Sun Belt's still hot. I mean, it's a little, I get tired of hearing that, just like I'm sure you do, because again, it's looking at these kind of what predominantly end up being red states, more business friendly, and a lot of migration, right? More companies keep relocating to DFW, for example. So with those companies comes more jobs. With those jobs comes more demand for a place to live. So I think it continues to be hot. I'll tell you, Dallas had 33,000 units delivered in 2023, 35,000 expected this year, and just 21,000 are expected next year in 2025.
It's crazy. It's crazy that they're still building some. I mean, you're talking about 70,000 units.
But they've been in the pipeline for a while, right? But what's interesting is 2025 being 21,000 units coming online. That's about where we were in Dallas in 2016. So to me, like that sounds good, right? I mean, that's before things got just crazy, but still there was some growth there. So, I think, as with anything, this is supply demand.
But these are 70,000, I mean, just between 23 and 24, right? 70,000 units that stand to be absorbed, new units.
Yep.
Right? Not to mention the market that already exists, which is massive. Not to mention everything that got delivered in 22 and before that. And it gets scary when, you and I both know this. As developers build, the market that is driving the demand, it lags. It lags behind. It takes a while, in other words, to stop filing new jobs and wait and sit on the land.
Right.
So you have this buildup of more units, a lot that needs to get leased up, a lot that's on high interest bridge loans, construction loans, waiting to get leased up, coupled with, a market that, again, like the economy seems fine. We're adding jobs. Inflation definitely slowed down, but complete TBD of what's going to happen in the banking markets. It just seems very reminiscent, right? Like all of this is very easy to get scared about, and I flip-flop on both sides.
I would agree, but for the fact that there is such a strong decrease in new deals coming online in markets like DFW come 2026, 2027. So that's why I keep saying any developer who delivers a deal in those 2 years should be able to crush it, because you're going to continue to have stronger demand. You're going to continue to have in-migration from other markets, and everyone needs a place to live, and there's not going to be much coming online by that time. So I think right now there's a little bit of softness in the market, but I can already see that changing. And I think everyone kind of has their eyes on where we're going to be over the next year or two, rightfully so.
I see that happening with the office markets here in New York, by the way.
How do they come back? What do you think what do you think?
It's pretty simple. Again, it's not to be conflated with the state of the general market, right? Office on 57th and 5th is not the same as office in the financial district in New York, right? For at least our New Yorker listeners will understand this.
Yeah,
right?
And that's interesting because, financial district, FIDI, as it's referred to, that's historically where all the offices were. That's where everyone wanted to be.
There's no banks left on Wall Street.
It's so crazy.
Right?
It's so crazy.
Because, look, so you were asking me how I think this bounces back. I think it bounces back in the corridors that matter, right? Like your Plaza District, Midtown, that has your alternative asset managers, high finance, stays hot, right? Like Apollo isn't blowing out.
Right.
KKR is not blowing out.
Right.
It's going to matter where the location is, right? So Plaza District stays. Anything near Grand Central stays because you've got Westchester and Connecticut commutes. That's the executive port, let's call it.
Yep.
Office near there is always going to be hot. So however you map that. Office on parts of 6th Avenue, even parts of 7th Avenue, north of 50th Street, that are really close to Central Park. It's going to work. Bryant Park, again, close proximity to Grand Central.
Yep.
It's going to stay. The demand in those areas is inherently going up because there's no new filings. Very few people are building office, right? Like, the names that are. You've got One Madison.
Super high profile projects.
So you have no new jobs. You have no new jobs in terms of like assets being created.
Yep.
You have tenants who still are seeking out high quality space.
Right.
By the way, like the economy for them has been good. They're not dying to pay less money.
Right.
They just need less space. A lot of these guys, especially in like alternative asset managers, they'll pay the same amount of rent just for higher quality space.
Right.
Right. So you have to produce these buildings. Like they're not a building that hasn't been renovated in the last 20 years doesn't have what we talked about before, right? The Equinox level gym, the high amenities, private dining, all that kind of stuff.
Yeah, Hudson Yards crushed it, right? I mean, it's a lot of demand there because that's one of the that's where all the new sexy buildings are.
But what is happening is that some of these corporations are taking the low cost providers off the market.
Yeah.
So earlier this week, JP Morgan said that it's buying 250 Park Avenue. 250 Park Avenue is by far the low cost provider in that corridor.
Okay.
Right? You're talking about rents in like high 70s, low to mid 80s.
So what's the play?
Where the rest of Park Avenue is like pushing $100 plus rents.
Okay.
You have new buildings being created, right? L&L's got a new building up. JP Morgan's buying the building that's directly adjacent to their new world headquarters. Right?
Yeah.
So not only are they driving up the price of the assets on the street because they're developing. There's a lot of new development. They're taking off the low cost provider. Similar sense, Amazon's looking at a building directly next to their world headquarters. So this is going to continue to happen.
Yeah.
And as you remove the low cost providers, as you don't file new jobs, and as people are coming back to the office more and more, I understand that it hasn't been at the levels we've seen. Like it didn't jump from 50% attendance to 90% attendance. It's still growing.
Right.
It's still growing. So as people need to come back, there's going to be a real quick race to like, shit, we need space.
Yep. And you don't want to be late, right? Because that takes time.
I think they already are.
Yeah.
I think they already are late. And there's very few people who, did the math and said,
it's really hard when you're in the moment to be focused on long term like that. It's really hard when you see that there's still not as many people in the office. Not if you have deep pockets
and you don't owe a timeline to investors, right?
Yeah.
So Amazon, JP Morgan can afford to do this. And guess what they just did? They bought their next headquarters at a fraction of what it would cost them any other year.
Well, let's talk about JP Morgan. So
let's end it. Let's end it on this.
We're running
by the way,
whoa. Yeah.
Let's play. Let's start playing a game.
What?
Right?
Go.
Because I feel like we talk about Fed cuts weekly at this point.
Okay.
Right.
Yeah. You want to do an over under or?
I don't know. Do we get DraftKings involved and start collecting spreads on this? Can our listeners help us capitalize on this a little bit more?
I'm pretty sure you can now bet on that, right? There's platforms now where you can bet on all sorts of strange things, and I think that's one of the things that folks are voting on. But everyone keeps saying September will be a rate cut, probably just 25 bips. Yeah. Not a huge deal. Not going to change everything. But Jamie Dimon is saying that might be too soon. And he's worried that that inflation might still not be under control, and that factors like government spending, global remilitarization, and trade restructuring, all these factors could contribute to higher inflation for longer. So it's interesting. I mean, and he's been kind of saying this for a while now. He's been more sort of reserved to say that there needs to be a rate cut in the near future.
Yeah,
what say you?
Was JP Morgan the one who, along with Goldman Sachs, said we'd see 2 cuts this year? Because if they are, I need to go back. Don't scout me on this.
I don't remember every single thing I read like you and some other people I know. But I will say this: I think 100% there's going to be. Personally, I really do.
September specifically, or this year?
I think I'm going September.
Got it. And bold claims, Jack.
I'm an economist. You didn't know this?
Hey guys, applications just open for a new co-host, just in case Jack gets absolutely canned for this prediction.
So I think a cut does come in September, and I see where he's coming from. I mean, man, the whole world's changing right now, and military spending for sure is going to have an impact. Well, I don't know. What do you think?
Yeah, I mean, I'm a little conflicted. Like I could see the world kind of coming to a halt until
elections.
You want to make a bold prediction. I think it's a landslide for Donnie T at this point. Whether people like it or not, I think he becomes the next president. I don't think Kamala Harris is anywhere near capable of dethroning his lead.
That's a pretty strong argument.
Hate me for this, interpret it whichever way you want. I'm being a realist. Like,
you think it's his to lose.
Yeah, and again, it's not because he's like my favorite candidate. It's just I don't see him.
Who is your favorite candidate? Tell us your politics and also your credit score. No one. Yeah. I think in my circle, everyone's of the same belief as you. Everybody thinks it's his. It's really his to lose.
I think no matter what side you're on, you have to be, guys, unless you're really blind to it all.
Yeah.
I don't think he stands a chance to lose. So
imagery means everything, I think, particularly in politics. And when you have that photo of him saying fight with the American flag in the background, it just resonates.
There's a myriad of factors of why, you know, he stands to win. Like, by the way, the guy used to be president, right? He already has the experience.
Right.
But let's not derail. Presuming that he wins, right? I see the markets either halting, you know, unless there's another assassination attempt in the next week. And if I just like predicted that like The Simpsons, then you and me are going to go play the lottery. But unless that happens, I see it being calm. You know, maybe some pricing in that he wins. If he wins, like definitely less military spending. Market will, you know, probably start to jump.
You're saying that with Ukraine, right? That's the main.
Well, I mean, he's made that point clear, right? That he cuts the funding
for Ukraine
immediately.
Yeah.
And in general, I think he's going to be much more focused on the broader economy and not defense spending.
Yeah. Well, so I'll tell you some of the tariffs are a little scary. I don't know how some of those would pan out that he's proposing, but too soon. We don't know. Let's see. Let's play it out as the year goes on.
Yeah. So you make the bold claim.
September
rates
rate
are going to
cut.
drop. Yeah. I'll make the bold claim. You know, Donnie T's
done.
Winning the race.
We'll come up with an amount we'll bet on later, and we'll figure it out.
I have an idea.
Yeah.
I have an idea.
Tell us.
If I win.
Yeah.
You have to hire DJ Jackie Jack.
Okay.
To play for this next podcast.
Okay.
Yeah. On the subsequent podcast.
Yeah. Okay. Got yourself a deal. And if I win, you have to, let's see. I mean, you went to the shore. You were supposed to get I mean, I would imagine you got tan there, but not really. Wow. Like you need, so maybe get some sun. If I think you have to go to a tanning bed and put on that crazy bronzer that people put on. That's
utterly disgusting.
Yeah.
But
whatever.
Because I'm a man and a man of my word, I'll take it.
Okay, cool.
I'll take it. Right. I'll do the crazy bronzer.
On that note, let's end it.
All right.
Cool.
We're out.
See ya.